Hello friends, my name is RISHI UDESHI. Welcome to my channel UPSCpedia. We have started a revision lecture for economic static with the perspective of civil service prelims. Besides, to give the students much needed confidence, we will also be discussing the previous year's civil service prelims questions on economy. And let's begin with the topic. The topic for today is, let's look at the slide. Okay, the topic for today is national income. This is my channel UPSCpedia. And this is me, RISHI UDESHI, and this is my email ID. Just in case if you have any kind of doubts or any queries or anything, you can always give me an email here, drop me an email. And since this is a revision lecture, I'll be taking the liberty of assuming that you may already be aware of these topics. So I'll be touching with these topics, not that much in detail. However, if you require any kind of clarity or any kind of, if you have any kind of query on any of these topics, the detailed explanation on each of these topics is available on my channel UPSCpedia. Please visit there. And yeah, let's begin. The contents which we'll be dealing with are national income, associated terms that will include factor, cost, market price and everything, and GDP deflator and the previous year's questions. So these are the contents which we'll be dealing with. Let's begin with our topic, national income. And in the topic of national income, we are already aware it is nothing but the net result of all the economic activities in any country within a period of 1 year or usually a designated time in a value, and it is valued in terms of money. Basically, so national income is measured in the form of these four terms: GDP, NDP, GNP and NNP. Let's quickly learn about these topics. So GDP, you guys already must be aware, GDP stands for gross domestic product, and I have already underlined few important words here. It is gross, then it is domestic, then it is final, then boundary and period. So what does gross mean? Gross means that we are not considering depreciation here. We are not considering the loss in the value of goods because of wear and tear. So we are not considering depreciation. In case of NDP, net domestic product, we will be considering depreciation. The next is domestic. Domestic shows the importance of the economic territory of India. So any entity who is there in within the economic territory of India, his contribution to the national income will be considered in GDP. However, an Indian national somewhere abroad in some other country, his economic contribution will not be considered. So that is the significance of the word domestic, which also is the significance of the word boundary. Then comes final. The importance of the word final means we are not considering the intermediate goods. Then there is period. So it should always be within some period. So it is usually either for quarterly figures of quarterly GDP figures we get, or either 6 monthly, or we get yearly GDP figures. So all this is something. So it is always with respect to a period. Apart from this, this line also shows that the GDP can also be shown as the sum of private consumption plus investment plus government spending plus exports minus imports. That is nothing but trade balance. So remember this. Why I am asking you to remember? Because in the later slides we will be learning more about it. It is a quantitative term. It's not a qualitative term because if we would have considered the quality, we would have also considered depreciation. So it's just a quantitative term and used for comparison across the world. The next term is NDP, net domestic product. It is the net domestic product. Since net, there is a word net here. It says there is a change from the word gross to net. So that's why we'll be including the word depreciation. Since we have considered depreciation, it is more practical because wear and tear is a fact of life. It is less reliable because depreciation rates are decided by the governments and hence not used for international comparison. Besides, it is a qualitative term and shows the country's R&D development. Why? Because since it is a qualitative term, it shows that how far the goods are of good quality. If they are of good quality, the depreciation rates of course will be less. This is at times also used by the governments across the world to signal the market whether to promote production of one particular goods or not. Moving on, the next term is GNP, gross national product. Here there is, the word is gross, so we won't be considering depreciation, but then here there is national. It's not domestic, it's national. What does this mean? This means that we'll be considering the nationality of the individual. So if there is a foreign national in India, his economic contribution to India's national income will not be considered in gross national product. However, if there is an Indian national somewhere abroad, maybe in USA, his economic contribution to national income of India will be considered in GNP. So that's the significance of the word nationality. And basically it's nothing but GDP minus income from abroad. And do remember the contents of income from abroad includes private remittances. Remittance is the amount of money the NRIs send to India, that is remittance. Then there is interest on loans and then there is external glance. And usually in these two cases, India is negative. Earlier we were positive in external grants, now we have turned negative in external grants, and this is always positive in case of India. But the total net effect of this, we realize that the income from abroad in case of India is negative. So this term is more dominant as compared to the private remittance. Okay, moving on to the next slide. The next slide is about NNP, net national product. And net national product, it means we are considering depreciation. National means we'll be considering the income from abroad. It is the purest form of national income, very true. So if you look at this definition here, it is GDP minus income from abroad. Since it is national, so we are considering income from abroad also, and minus depreciation. Why? Because it is net, it's not gross, it's net. So, and if just remember this, that per capita income is nothing but this national income divided by the population of the country. That's nothing but the per capita income. Moving on to the next slide. Next slide is about the associated terms. The associated terms, it can be the first two terms to discuss here are factor cost and market cost. Factor cost and market cost. So it's these two terms are written here. What is the difference between both? Factor cost is the cost of the product at the outlet of the factory. The market cost is the cost of the product at the consumer end. And there is a difference between both. What is the difference? The difference is brought about by taxes and subsidies. So let's read the first point. The first point is about the national income at market cost will be the national income at factor cost. So outlet of the factory plus you add indirect taxes because government applies some taxes on it and government gives some subsidies. So plus taxes minus subsidies will give you the national income at market cost. Fine. Moving on, the next is basically okay, so you can read these 2 points. Just remember this, that the factor cost is nothing but the input cost of the producer, and while the market cost is also called as the ex-factory price. The market cost is also called as the ex-factory price. Moving on, the next terms are nominal, real and disposable income. So just in very short, the nominal income is the income with inflation effect. So nominal income will have the effect of inflation in it. The real income will not have the effect of inflation. We have removed the effect of inflation from the nominal income and then we get the real income. And disposable income is the income you get after deduction of the taxes. Finally, the income which an individual has to spend, to dispose. So that's disposable income. So these are the 3 terms. Just remember, nominal income has the effect of inflation, real income do not have the effect of inflation, and disposable income is something which is obtained after deducting the taxes. So next term is about base year. The base year is about, okay, here just remember 2 more terms. The terms are current price and constant price. So similar to that of the nominal real, the current price is something which involves the effect of inflation and use the prices of the current year. Use the prices of the current year. Whereas the constant prices is something which considers which is without the effect of inflation, and it uses the base year prices. It uses the prices of the base year. In case of India, the base year is 2011-12 and it is usually allocated the index of value 100. And okay, one more thing to remember here is that current prices, the GDP calculated at the current prices of the goods will be called as the nominal GDP, and the GDP calculated the constant prices of the goods, I mean the prices of the base year, will be considered as the real GDP. Fine, do remember this. Let's move on. The next term is GDP deflator. So what is GDP deflator? GDP deflator is nothing but the ratio. Remember, it is very important now. GDP deflator is nothing but the ratio of GDP at the current price to the GDP at the constant price. So there is GDP at the current price to the GDP at the constant price. So basically nominal divided by real. That's nominal by real. And in other, more than this being a term for the topic of national income, it is more relevant to the topic of inflation, but I considered to involve it here. And now if in case the GDP deflator is 1, it means the GDP at the current price is same as GDP at the constant price. Effectively there is no change in the inflation in the country. There is no change in the prices of the products in the country. And if the GDP deflator is 2, it means the GDP at the current price is twice the GDP at the constant price. It says that the prices have increased by 2-fold. So the prices have increased twice. So that's something which is the GDP at the current price and GDP at the constant price, and it is more better an indicator of inflation rather than being a term for the national income. Moving on to the last part of this slides, it's previous year's questions, and let's quickly discuss the previous year's questions. So the national income of a country for a given period is equal to what? It is equal to the total value of the goods and services produced by the national. So we have already discussed the definition in the GDP wala part, wherein we had discussed it is nothing but the sum total of final value of goods and services produced by a country within certain period. So that was the definition of GDP, and this is the answer to the question. The next is increase in absolute and per capita real GNP do not connote a higher economic development. So now here you will have to understand the difference between the word development and growth. So there is a difference between both the words. Economic growth is something which is a quantitative term. It's if there is a growth in GDP, we say it's an economic growth. But is there development? No, the development will only be there if there is development of the humans living there. So if we have a higher economic growth along with reduction in poverty, reduction in hunger, reduction in inequality in the society, then we say there is economic development. However, if there is just increase in GDP growth, real GDP growth, if there is just increase in real GDP growth, we do not say that there is economic development if there is higher poverty and unemployment in the society. So that's the answer. The answer is C. Moving on to the next topic, the next question. The next question is, okay, so that's asking you the formula of the national income, Y of the country, and we have discussed already in the slide of the GDP, we have discussed, it is already given in the formula C plus I plus G plus X minus M, where C stands for consumption, I stands for investment, G stands for government spending, and X minus M stands for exports minus imports. Which one of the following, the next question, which one of the following is the correct sequence of the decreasing order of contribution of different sectors to the GDP of India? And okay, so here the highest contribution is given by services, then comes industry, and then comes agriculture. I guess the answer marked here is wrong. Just this is the answer. This is the proper answer. The first is services, then is industry, and then there is agriculture. So there is answer is A. This is not the answer. Okay, moving on. The next question. The next question is the most appropriate measure for economic growth. This we know. We read it almost every day in the newspapers. The most appropriate term for cross-country comparison of economic growth, it is the GDP, gross domestic product. The next is with reference to Indian economy, consider the following. Okay, now I like to highlight this statement separately. Why this statement this question I am highlighting? Because this question, it has been noticed that this question has come time and again in the civil service paper. Every few years, every 3-4 years, they tend to ask this kind of questions. So I request all of you guys, whichever year you are going to give this examination, I want you guys to read a question similar to the type like the rate of growth of real GDP has steadily increased in the last decade and on all, this kind of questions. GDP at the market price in rupees has steadily increased. This kind of questions, the questions which ask about the GDP trends. So such kind of questions are repeatedly been asked. I request you guys to have a look at the economic survey part 2 of that respective year and just analyze the GDP of last 5 years, of last 10 years, and have a look, has it steadily increased or not, and then you will get the proper answer to this question. So I mark this question specifically separately so that I want you guys to be aware whenever you're going to give this exam. The next, now these are the two topics, these are the two slides which I have added, which I feel are not that important since the question has not been asked till date, but anytime a question can be asked. The topic here is GVA, gross value added, and this is not that important topic, but of late the government of India has started measuring economic growth of the country. Along with GDP, they have complemented the figure of GVA also, gross value added also. Let's quickly understand few important points of this. Remember this, that the gross value added GVA is a sector specific, gives you a sector specific picture. So that's the first difference with GDP. The second is, it is the cost of goods produced minus the cost of the inputs. So of course, since it is value added, gross value added, so it is cost of the goods produced minus cost of the inputs. That will show you how much value has been added. So the second point, do read this. And the last is, it gives you a producer or supplier perspective, supplier side perspective. Very true. How much amount of value has been added will be revealed by the supplier side. It is nothing but the supplier side perspective. However, the GDP is something which is a consumer side perspective. So these are the same points which I have written below, but in more detail. If you want, just have a look here. GDP gives you the picture from the consumer side or the demand perspective, whereas GVA gives you the picture from the producer side or the supplier perspective. So it's the same point which are mentioned below. These are just the important points which I feel are important for revision. And moving on, the next is approach for measurement, the approach for measurement of GDP. So there are three approaches. All of you guys must be aware. It is income approach, also called as factor cost, Remember this thing, income approach is also called as factor cost. The next is expenditure approach, and the last one is value addition, production or output approach. So there is income approach or factor cost, then there is expenditure, then there is value addition, production or output approach. So these are the three approaches. The detail about this I have already discussed in the lecture, in the detailed lecture of the same topic, which is already there in my which is already there on my channel UPSCpedia. Have a look there. The next thing which I wanted to discuss is about normal residents. Time and again in the discussion of national income we read about the term normal resident. So who are these normal residents? Normal residents are those individuals who ordinarily reside in India and for a period of 1 year. So remember the figure, 1 year or more is important, and also there is another condition. The condition is their center of economic interest lies in the country. The center of economic interest should lie in the country. So those individuals will be called as normal residents. Not expecting question on it, just a trivial information just in case if they ask you question. Let's move on. The next is again one more term, domestic territory. So domestic territory, we have discussed this word domestic, gross domestic product, in the definition in the full form of GDP. So domestic, we knew it's nothing but the domestic boundary of the country, but it does not mean political territory. It means economic territory, as mentioned here. It is economic territory, it is not the political territory. And economic territory is a vast term, it is a bigger term, it is a greater term. It's exactly is not restricted to the political territory of the country. So that's the last slide. And thank you. My name Rishi Udeshi. My email ID UPSCpedia 12@gmail. Drop me an email if you have any kind of doubt, or if you have any request, if you want me to make any video on particular topic or something. And my channel UPSCpedia. Of course, the above lecture is the revision lecture, so I dealt with the topics pretty much superficially. If you want detailed explanation on each of these terms, it's already available on another video on my channel UPSCpedia. Please have a look there. Thank you.